Let me tell you about something happening right now in the silver market that almost nobody is talking about. While the mainstream media keeps you distracted with the latest headlines and trending stories, there's a mathematical problem brewing that could fundamentally change how precious metals are priced for years to come. COMEX, the world's largest silver exchange, currently has about 103 million ounces of silver available for delivery. That might sound like a lot, but here's where it gets interesting. They're facing over 400 million ounces worth of open contracts due in just the next month. Think of it like having 100 pizzas when 400 hungry people show up expecting dinner. The math simply doesn't work. Every single day, about 785,000 ounces of silver are leaving COMEX vaults. This drain isn't slowing down, it's accelerating. Something has to give, and soon. Whether you own silver, you're thinking about it, or you just want to understand what's happening in the financial system, what unfolds in the next 30 days could reshape the entire metals market. And here's something most people don't realize. You literally can't spell AI without metals. So even if you're just a tech investor, this affects you. Now let me explain what COMEX actually is, because most people don't really understand it. COMEX is the commodity exchange where silver and gold futures are traded. It's technically part of the CME Group, the Chicago Mercantile Exchange, and it serves as the official price-setting mechanism for precious metals in America and much of the world. Here's the crucial part. COMEX is what we call a paper market. Most people trading there never actually touch physical silver. They trade contracts, promises to deliver silver, and the vast majority of these contracts are settled for cash, not actual metal. It's like a restaurant where 95% of the customers just exchange pictures of food and then leave without eating anything. COMEX has two categories of silver in their vaults, and understanding this distinction is critical. First, there's registered silver, which means it's available for delivery. This is the stuff that can actually leave the vault when someone demands their metal. Then there's eligible silver, which sits in COMEX vaults but belongs to someone else and isn't available for delivery unless the owner decides to move it or sell it. Think of it this way. Eligible silver is like your neighbor parking his car in your garage. Yes, there's a car there, but it's not your car. When COMEX reports their total inventory, they love to combine both numbers because it makes their vaults look much fuller than they actually are. It's like claiming you own 12 Ferraris when 11 of them belong to other people and you only own the Honda Civic. As of February 2026, COMEX has about 103 million ounces of registered silver that actually matters. The total inventory is over 400 million, but most of that is irrelevant because it doesn't belong to COMEX. Here's where things get urgent, though I'm not trying to be alarmist. Registered silver is down 70% since 2020. We're seeing almost 785,000 ounces walking out the door every single day. And this drain is accelerating, not slowing down. In 2020, they had over 300 million ounces. Now they have 103 million, with nearly a million ounces leaving daily. How long can this continue? Let me give you a simple framework to understand what's happening. I call it the vault pressure position framework. First, we verify what's actually in the vault. Then we understand the pressure that's building. Finally, we position ourselves accordingly. We've established that there's 103.5 million ounces in the vault right now. But this isn't all sitting in one place. COMEX vaults are spread across multiple facilities managed by different banks and depositories, and the number changes every single day. In January 2026 alone, almost 50 million ounces left those vaults. Why is that shocking? Because if you look back at 2024, only 6.8 million ounces left for the entire comparable period. That's a 7 times increase in silver leaving the vaults. The official explanation from the exchanges is that this is normal market activity. Right, because your credit card bill being 7 times higher than usual is totally normal spending. This isn't just a COMEX problem either. Shanghai silver inventories are at their lowest since 2016. The London Metal Exchange is at historic lows. It's like musical chairs, and the music is getting very quiet. Both China and the United States have now classified silver as a strategic material with export controls. We're not talking conspiracy theories here, we're talking public government policy. There's one indicator that tells you whether there's plenty of silver or whether we're genuinely short, and most people never hear about it. It's called the silver lease rate. This is what it costs to borrow physical silver. Why would anyone want to borrow silver? Well, if you want to short silver, You need to borrow the physical metal first, and you have to pay interest to whoever owns that silver. Normally, it costs less than half a percentage point to borrow silver because it's plentiful. Right now, it's at 8%. When lease rates spike like this, it means physical silver is hard to find. People are willing to pay 25 times the normal interest rate to borrow silver. This doesn't happen when vaults are full. It happens when vaults are empty and people are scrambling. Now let's talk about the pressure building in the system. March is a main delivery month for silver on COMEX. This means contract holders who have paper silver can demand physical silver. And the numbers are staggering. There are contracts for about 500 million ounces, with only 100 million ounces of silver actually available. Think about what happens if just 10% of these contract holders demand physical delivery instead of cash settlement. That's 50 million ounces that need to leave vaults that only contain 100 million total. If 20% want physical delivery, you're looking at the vaults becoming essentially empty. The critical date to watch is February 27th. That's the first notice day when traders must declare whether they want physical silver or cash settlement. Between now and then, at the current drain rate, another 16 million ounces will likely leave COMEX. Here's another striking data point. In February 2026, the delivery rate is running at 98%. That means 98% of people who can get their silver delivered are actually taking delivery. Over 18 million ounces have been delivered this month alone. These aren't silver believers or conspiracy theorists. These are traders and hedge funds who realize they can buy paper silver at paper prices and convert it to physical silver. Why would they do this? Because when you try to buy physical silver from dealers, they tell you delivery will take until June or July. There just isn't any available in the normal market. But if you have enough money in your COMEX account, you can buy the paper contracts and convert them to physical silver immediately. Industrial users might be doing exactly this. Imagine you're building a massive chip manufacturing facility. You need enormous amounts of silver for robots, chips, and electronics. Miners tell you they can deliver in a year. Traders say 6 months at a premium. But COMEX will sell it to you today at current prices. Why wouldn't you take that deal and store the silver yourself? So what happens if COMEX runs out of silver? They have several options, all of them problematic. First, they could simply give cash instead of metal. This is actually legal under their exchange rules, but it destroys their credibility as a price-setting mechanism because they're basically admitting they're not really a silver exchange anymore. Second, they could change the rules. They could raise margin requirements to force people to sell their contracts, which they've already done 3 or 4 times this year. They could impose position limits or make it harder to get delivery, which is exactly what they did in 1980 and 2011. They've even introduced a new futures contract that has no right to underlying silver at all. It's just cash settled. Third, paper silver and physical silver prices could diverge dramatically. We're already seeing this. Shanghai's physical silver premium is about $40 above COMEX paper prices. In a free market, you'd buy physical silver at COMEX and ship it to China for a profit, which is exactly the arbitrage that happened with gold in early 2025. COMEX says delivery issues are theoretical, that everything is fine. But I've learned from people who actually worked on these metal exchanges that markets repeat patterns. They don't repeat exactly, but they rhyme. In 1980, there was Silver Thursday. The Hunt brothers had accumulated a massive silver position, and silver was heading toward $50. The exchange changed the rules, implementing something called Silver Rule 7, which limited trading to selling only. You could sell but not buy. Sound familiar? It's exactly what Robinhood did with GameStop. Silver crashed from $50 to $10, an 80% decline, and the Hunt brothers were wiped out. The exchange claimed they were maintaining an orderly market. In 2011, we saw the margin massacre. Silver was surging after the financial crisis, hitting $49. CME raised margin requirements 5 times in 2 weeks. Each increase forced leveraged traders to sell, creating a cascade that crashed silver by almost 50%. See the pattern? Silver threatens to break out, the exchange changes rules, prices crash. Same playbook, same players, same outcome. We saw this in December and we're seeing it again now. But here's what's critically different in 2026. In 1980 and 2011, COMEX had plenty of silver. The vaults were full. In 2026, the vaults are nearly empty. They can change rules and raise margins, but they cannot create silver that doesn't exist. Now, let's understand the fundamental backdrop. Silver has been in a supply deficit for 5 consecutive years, roughly 200 million ounces per year. Since 2021, we're about a billion ounces short. Why? Demand is exploding. Each solar panel needs about 20 grams of silver, and solar installation is growing exponentially. Electric vehicles need 5 to 10 times more silver than gas cars. AI and electronics consume massive amounts. Semiconductors require it. Total industrial demand is about 700 million ounces per year, and growing rapidly. Why don't miners just produce more? Because 80% of silver is a byproduct of mining copper, lead, and zinc. Only about a quarter comes from dedicated silver mines. You can't just decide to dig up more silver. Even if prices double, it takes years to bring new mines online. The lead and zinc mines where most silver comes from won't increase production unless there's significantly more demand for lead and zinc themselves. We need to distinguish between paper silver and physical silver. Paper silver includes ETFs, futures contracts, and mining stocks. The advantages are liquidity, easy trading, no storage costs, no insurance, no security concerns. The disadvantages are counterparty risk, you might get cash instead of metal, and paper might not track physical prices when the two markets diverge, which is happening right now. Physical silver means coins and bars you actually own. There's no counterparty risk, it's yours. But you have to store it securely. You pay a premium when buying, and it's less liquid than pushing a button to sell an ETF. The financial industry's official position is that paper and physical silver are equivalent. That's true until it isn't. When Shanghai pays a $40 premium for physical over paper, they're clearly not equivalent anymore. I'm not saying silver goes up tomorrow. They could change rules again. There could be short-term crashes. We've seen it repeatedly. The risk is that short-term traders get burned again. But the opportunity is based on the fact that vaults are nearly empty, the supply deficit isn't going away, and industrial demand is growing, not shrinking. Even if they paper over the next month or two, the fundamental problem remains. Some analysts have $300 price targets. Others say $50 is the new floor. I won't give you a specific number because nobody actually knows. But the supply and demand fundamentals are the tightest they've been in decades, possibly ever. So what should you actually do with this information? Watch February 27th, the first notice day for March contracts. Watch how many contracts stand for delivery. If it's above 75 million ounces, things could get very interesting because COMEX will be out of silver quickly. Track the registered inventory daily or weekly. If it drops below 80 million ounces, the math becomes problematic. And watch the lease rate. We're at 8% now. If it goes higher, it's the market screaming that physical silver is scarce. Our framework is simple. Verify what's actually available, not headline numbers. Understand the pressure building as contracts convert to physical. Then position yourself according to your timeline and risk tolerance. Silver is highly speculative. It probably shouldn't be, but it is because powerful interests have profited from this speculation for decades. Gold is arguably the less speculative long-term hold. You need to ask yourself, can you handle the volatility? If the last crash made you lose sleep, you have too much silver. The biggest factor in risk tolerance is portfolio percentage. If you have 10% of your money in silver and it crashes 30%, you've lost 3% of your total wealth. That might be manageable. If you have 20% in silver and it drops 30%, you've lost 6% total. That starts feeling uncomfortable. Understand your position sizing and whether you can handle the downside. The smartest traders only care about this. How much of my money is actually at risk? The exchanges will tell you this is normal market activity. They're technically right in the sense that when the house always wins, rigging the game becomes normal. The question is whether the fundamental mathematics of empty vaults and surging demand will finally overwhelm the paper games that have controlled this market for so long. What happens in the next few weeks could provide the answer. Stay informed, understand the real numbers, and position accordingly.